Ever since I started my YouTube channel a little over a year ago, the number one concern or the number one criticism that I get from many people on many of the stocks that I talk about and preach about is that the share price trend or the share price history, whatever you want to call it, doesn't look good. So this is especially true for the higher yielding funds like the split funds and the income funds that I talk about. And I totally understand that, guys. I'm not arguing or disagreeing with you whatsoever. To the contrary, I actually agree with you wholeheartedly on your assessment. I mean, how could I disagree anyway when the 10-year stock price chart is staring me right in the face, right? So I'll be completely honest with you, as I've always been since starting this channel. I mean, if you've been following me for a while now, you know that this is true, right? I unveiled my entire portfolios to you guys in my last two videos, including my capital losses. I even showed you my RRSP accounts directly in my broker. I'm also planning to do a video which goes over my entire financial blueprint. So the truth really is that I'm really not concerned about stock prices or stock price trends. And the more time goes on, the less they are a concern to me whatsoever. So I know what you're thinking as an investor. How is it even possible not to care about stock prices? I mean, it seems like it's the only thing that matters when you invest in stocks, right? So the statement seems a bit ridiculous. So in this video, I will justify why. Because not caring about stock prices might just be the best and most underrated advantage of the passive income investing strategy. So let's get in it right away, guys. Let's not waste any time. Reason number one, I'm an income-focused investor and not a growth investor. Big difference. Growth investors only care about one thing, buying low and eventually at some point in time, selling high, right? How do they achieve that growth? Well, there's only one way to do it, the growth of the share price. This is called capital appreciation, which is exclusively dependent on share price performance, right? The growth-focused investor invests now to hopefully have much more money at a later time, thus growing their money. But then the questions become, how much later? Should I sell when I'm up 10%, 20%, 50%? What if I don't sell and the stock price drops significantly? How long do I wait after that? Or what if I need my money now and it's a bear market or a recession and stock prices are down? The point is, to get your growth or actually realize your gains, you need to sell part of your assets or your stocks. The passive income focused investor, on the other hand, focuses on the income the stocks provide. Never worry about when is the right time to sell because you are getting your money consistently now rather than later, all the while maintaining your time in the stock market. So what I care about above all else is getting consistent and safe passive income, knowing precisely what your investments are doing and how much income you receive on a monthly basis is really a huge psychological advantage that this strategy provides. So just like a consistent paycheck, guys, right? But in this case, you don't have to work for it. Instead, you can focus on your interests, learn a new skill, spend quality time with your loved ones, or even start a YouTube channel. So the cash flow while maintaining time in the market is how passive income investors win. Remember that assets are always there if you want to sell, but all the while you're making money just holding it. During bear markets, pandemics, recessions, natural disasters, whatever is going on in the world, your investments are earning you dividend income and premium income from those covered calls. So our goal is not to increase or grow our capital, but it's to increase and grow our income. What we do with that income every month is entirely up to us. Pay all your bills and living expenses like I do, reinvest the income to buy more stocks, thus increasing your income. The choice is really yours. The higher the income you have, the more options we have in life. It's as simple as that. So the lesson, substantial growth does take time and stock market volatility can mean big gains, but it also can mean big losses. But the assets that provide income solves two problems. You get your cash flow now while maintaining your time in the market. It's a no-brainer. Reason number two, I'm a buy and hold investor, not a trader. So this one's a no-brainer, right? I think I must have said buy and hold like a million times in my videos by now. So traders buy low and sell high. Why? Well, that's how they make a profit, right? So which stocks are best suited for trading? Well, stocks that are more volatile, stocks that don't give a dividend, for example, or penny stocks, or newer and unprofitable companies, or companies that are struggling right now. Then once the share price goes up, you sell the stock to somebody else in order to make a profit, and then you do a rinse and repeat. So if you're an income focused investor, you're doing none of that. You're buying stocks and holding them for the really long term to get that consistent income that they provide. So if you don't intend to sell the stock for a very long time, if ever, you're not thinking about when to sell, and that takes a huge burden off your shoulders. It's common knowledge that over time, the stock market goes up. So why buy and sell your assets? Also, why spend time trying to analyze? Speculating what to buy and sell next can be a huge waste of time, and we all know that time equals money. Reason number three, the stock price is only one part of the equation, very small part of the equation if you're an income investor like myself. So what do I mean by that? Well, we all heard the popular saying, don't judge a book by its cover, right? You could even apply this reference to people as well. We sometimes judge people on how they look or how they dress. This is a very important lesson to learn very early in life, because when you actually read the book, or when you actually talk to the person who you initially judged ahead of time, you usually end up being pleasantly surprised, right? Well, if you look at stocks and if you only look at the share price, you're doing the exact same thing. There's much more you need to look at besides the share price, like the dividends that this stock provides, the dividend policy, and of course the underlying stocks or the holdings that this stock has. So this is especially true for buy and hold passive income investors like myself. Although the 10-year stock price chart might not look great, or the stock has gone down in terms of share price, it's possible that the stock has already given you back all your money in dividends alone. Let's look at two examples real quick so you see what I'm talking about. Let's start with one of my favorite income funds of all time, Canoe EIT Income Fund. So 10 years ago, this stock was trading at about $14 a share, and today it's trading at about $10.50 a share. So that's not really great, right? That's a drop of about 25%. Yeah, but what about all the monthly dividends in the last 10 years? You need to factor that in to get an accurate assessment. So for the last 10 years, EIT has provided us or provided its investors with an annual dividend of $1.20 per year, or 10 cents a month, and they haven't missed one payment. So it's pretty easy to calculate, right? $1.20 times 10 or 10 years gives you $12 per share, and that's in dividends alone. So to get an accurate number for your overall return, you need to factor in these dividend payments as well as the share price. So $10.50, the current share price, you got to add $12 to that, which is $22.50 per share. That's your share price. So even with the share price going from 14 to 10.50, you're still at 22.50, and that's a 60% profit. Let's take another example, DFN or Dividend 15 by Quadravest, a very popular split fund that holds about 15 Canadian dividend stocks. It started trading back in March 2004, and the first dividend was in April 2004. That's 202 months ago. So the stock was originally listed for $13 a share or about that, and now it's trading at $7 a share. That's a drop of about 46%. Pretty horrible, right? Yeah, but what about all the dividends that were paid out? You need to factor them in, all 198 of them. Luckily for us, once again, it's very easy to calculate because the dividend has never changed. It's always been, like the previous example, $1.20 annually or 10 cents a month. So what's 10 cents times 198? Well, that's $19.80. So if you invested in the stock at $13 back in 2004, you can't just consider the stock price. You need to factor in the dividend as well. So if we add $19.80 of dividends to the current share price of $7, you get your real number of how much you have now per share, which is $26.80, which is more than double your original share price of $13. Now, this case is especially powerful because even if the stock price or the share price went to zero, which it hasn't and it won't, you will still make a profit overall because you invested at $13 a share and you made back $19.80 a share in dividends alone. So the longer you hold a high yielding stock, the more the stock price doesn't matter. Remember that dividends are not done. They're still going every month like the energy bunny. So the longer you hold these stocks, the less you care about stock price because your real return is coming from the dividends, not the stock price. And I know what people will say, yes, you doubled your money or you made a big profit, but it took a long time, 10 years or 17 years. You could have been much better off investing in XYZ or doing ABC, whatever they say. Yes, you're completely right, but you wouldn't have gotten the consistent passive income all those years to enhance your quality of life along the way. Reason number 4, I don't play the what if game. Oh, I remember that what if game. It's like World of Warcraft. It's a game that never ends. What if I bought this stock at this price instead of that price? What if I held on to it instead of just selling it? What if I waited when the stock market crashed to invest? What if I played the lottery this weekend? And on and on and on. This is a game that never ends, guys. The what if game is always based on stock price, buying low to sell high. It's a very, very hard to pull off, especially for regular, ordinary people like you and me who don't have the time or the resources to actually play this game. This is called speculation. If you want to play that game, fine, but do you have any idea who you're playing against? Rich billionaires, powerful hedge funds with lots of money, lots of inside information. By the time you actually see an opportunity, it's usually too late. So how do you avoid this mind-boggling game, which will definitely drive you crazy? Trust me, I know because I've been there. Well, it's pretty simple. Don't play the game. Reason number 5 is I got better things to do. So this ties into my previous point to a certain extent. I got better things to do and to occupy my mind with. The last thing I want is to always think about the stock prices and worry about them. This is a big advantage of being a passive income investor because your primary source of income and profit is not the share price going up. It's the consistent and passive income that the stocks provide regardless of the share price. Now, you might argue, yes, but isn't the income tied in with the share price? Well, yes, to a certain degree, but I would say to a very minor degree. Just look at all the covered call ETFs that I own and preach about, for example, or the income funds. The stock prices all went down pretty hard last year, back in March and April during the COVID-19 crash, right? Like with everything else. Was the income impacted? Not at all. The income stayed the same for almost all the funds that I own, apart for some split funds, but that's just how they work. So stock prices go up, they go down every day based on the perception people have on the world economy. It's completely out of your control. It's completely out of our control. So why waste time worrying about that? It's like worrying about death. It's coming for us all. There's nothing we could do about it. So why waste the precious time that you have worrying about it, right? Time is the most valuable commodity of all. Don't forget that. Reason number 6, final reason, stock prices are based on emotion and may not reflect the actual value of the stock. So what actually dictates the share price of a stock or fund? Well, it's really the amount of buying and selling there is for that particular stock. It's all supply and demand. When a stock goes down, it's simply because there are more investors selling it than there are buying it. And when a stock goes up, it's because there are more buyers than sellers. It's as simple as that. It's all based on emotion, not logic or rationale. The best example I can give you to back this up are stock market crashes. Take March 2020, the COVID-19 crash last year. Let's look at a few examples. Royal Bank of Canada was $106 per share and it went to $76 per share. That's a 30% drop. Or Enbridge, $55 per share went to $34 per share. That's a 40% drop. Or even crazier, like Manulife was $26 per share and then it went to $13 per share. I mean, come on, guys. Do you really think that Manulife, a worldwide life insurance company, the biggest in Canada, that's been around for 134 years, can the company be worth 50% less in a matter of weeks? It doesn't make any sense, right? What about RBC, Canada's biggest bank? Can the bank be worth 30% less in a matter of weeks? Share prices, guys, are based on buying and selling. Stock market crashes are the result of exaggerated selling or panic selling, which happens because humans have herd mentality. Herd mentality is the premise that people can be influenced by their peers to adopt certain behaviors on a largely emotional rather than a rational basis. So Matthew McConaughey says it best in a scene of Wolf of Wall Street, one of my favorite movies, when he's having lunch with Leonardo DiCaprio in a high-end New York hotel. One of my favorite scenes in that movie. This is what he says: "I don't care who you are. Nobody knows if a stock is going to go up or if it's going to go down. It's all fairy dust. It's not on the elemental chart. It doesn't exist. It's all a fugazi." You know what a fugazi is? He's 100% right. So let me give you my final thoughts on this, guys. First of all, I just want to say there is no right and there is no wrong way of investing. Every investor has a different style and has different investing goals and needs. Yes, you could always invest in index type funds like SPY or some other low fee index fund from Vanguard or Ishares, VFV, and all those ones there. But for the investment to pay off long term, you need the overall stock market to rise significantly over time, right? The overall stock prices. With those types of funds, the dividend yield is very, very low, usually 2% or lower, which makes sense because these funds include dividend and non-dividend paying stocks. So investing this way is basically betting on the whole stock market, which is simply a reflection of the world economy, which is completely fine. I have nothing against it whatsoever. With my strategy, however, you're much less dependent on what the stock market does because the bulk of your returns comes from the income, the dividends and the distributions, and not capital appreciation. Covered call ETFs are especially less reliant on the market. In fact, they perform better during stock market volatility. I discussed this in my previous video where I discussed covered call ETFs in detail. So the main source of income for covered call ETFs are dividends and option premiums sold every month. Now, what about overall total return, which includes share price and dividends? Can you make a bigger overall return after 20 years with a growth strategy? Of course you can. You probably will. I'm actually admitting it on camera. But I'm more than willing to give up potentially higher overall returns for the following advantages that I get with my strategy. Number one, you get the passive income right away, providing you with a nice source of consistent income, which you can do as you please, spend it or reinvest it. Eventually, you will gain financial freedom or financial independence with my strategy, which will change your entire perspective on life and will allow you to quit your job and focus on other ways to make money and allow you to basically live for free. You can continue working, but at least it's an option, not an obligation. You don't care what the stock market does because you get paid no matter what happens. The only thing that you need is time. What the stock market will do when you end up needing to sell your SPY shares or Vanguard shares is anybody's guess. If you lose your job, at least you have some consistent income to fall back on. Imagine losing your job tomorrow, but you're making $2,000 a month in passive income. It's a huge weight off your shoulders. I mean, who are you going to trust if you lose your job? Government unemployment benefits, friends, family? I mean, come on, people, let's get serious. The only person you could trust is yourself. This is your responsibility and no one else's. Don't forget that if you don't need the income right now, you're very happy with your salary or whatever, you could simply reinvest the income via a drip. So you're making 7 to 8 or maybe 9 or 10% like I am a year in dividends alone. So by reinvesting it, you're essentially growing your money by the same rate, whatever your average dividend yield is. So 8-9% a year, which is actually pretty good. And beats the stock market anyway. With the SPY or another index fund like a Vanguard, you have no clue what your return will be every year. It could be amazing, like history shows us, or it might not. Like I said earlier, you might have to pull out some money at a loss if you need the money during a bad economic time. So in my opinion, I think it's definitely worth sacrificing some potential overall returns, for peace of mind. But that's just me. It's just my opinion. This is the investing style that makes me sleep well at night and doesn't make me worry, and that's priceless for me. So if you want to go the growth style with the passive index ETFs, go for it. I repeat, there is no right or wrong or good or bad way of investing. The right way is the way that makes you feel the most comfortable, that makes you sleep at night. Please visit our website, guys, passiveincomeinvesting.ca, to access my first ever digital product that I'm very proud of, the Ultimate Dividend Passive Income Investing Package, which includes a huge list of ETFs, split funds, income funds, high yielding single stocks and REITs, with my personal comments for each one, all the stocks you'll ever need to build your own portfolio. Also, keep in mind that if you purchase the product now and we come out with an updated version, which we're definitely planning on, you will get the updated version for free, so you won't have to buy it again. So you purchase it once, it comes with free lifetime updates. Also, keep in mind that you can book a one-on-one live video consultation with me, which I've had a lot lately. I'm booked until the next 3 weeks, which is great. I love helping people, meeting new people from all over the country. It's really a cool experience. I will do my utmost to help you answer all your questions, look over your existing portfolio, build a new portfolio for you, tailored to your custom needs. Whatever you need, I will help you. You could book that on my website. And as always, please support us. Please support our channel by hitting that like button. It's free for you. It helps out the channel, so it's a win-win. And finally, make sure you're subscribed so you don't miss out on my future content and the community posts as well on passive income investing. It's all designed to help you on your investing journey. We're also on Instagram and on Facebook, so join us there if you have those. Our mission remains the same, guys. It's to help everyday working Canadians to invest on their own in order to build their own stream of passive income to enhance their quality of life. So with that, take care, guys, stay safe, and see you next time.